And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, my God. Are you nuts?
With your host, Phil Grande.
And welcome. Okay, welcome to my podcast. Thank you for joining me today. Okay, let's get back to what's going on in the market. Now, if you remember, year 2000, 2008, 2020, 2022, those were all crashes or corrections, right? What do they have in common? Well, when you have the bond market always tells you before the stock market when the stock market's going to correct. Now there's several things. First, again, if you have yield spiking, what do I mean by that? If you go from let's say 4.45 where we are now, and you spike up to 4.50, and it keeps going, that you can get a correction or crash. On the other end, if the 10-year falls the other way from 4.45 where we are now down to 3.75 or lower, you can get a crash. Those are two danger zones. You should always know that. But it's never been wrong. It's never been wrong. Now, you have a couple of things that tell you when the market's going to crash. Credit spreads. Okay, what I just gave you, okay, the bond, the yields correcting one way or the other, overcorrecting, I should say, yields spiking, and liquidity turns negative, which means the four biggest central banks, all of a sudden they're tight, they won't lend, okay, they have a tight liquidity, turns negative. But the one that always works first, and it gave us a head up before 2000, 2008, 2020, 2022 was the yield collapse. So always watch that yield. Right now we're only 70 basis points away from a danger zone. In other words, if you take your investment grade bonds that trade for about 3.75, subtract that from a 10-year treasury yield, that's 4.45. That's 70 basis points. That's very, very close. Very close. That's very negative. So, and if it starts getting, especially if our 4.45 starts heading to that 4.50, then you gotta start taking some more profits. That's for sure. All right. So again, it's amazing what's going on. No matter how much you talk with these people, here, let me just run a cut. There's two cuts I want to show you. First, let's run Buffett's cut, and then we'll run the cut.
We've never had people in a more gambling mood than now, but that doesn't mean that investing is terrible. It does mean that prices for an awful lot of things will look very silly.
All right, here, now listen to this guy.
This growth is because of expected earnings. It's not really a speculative bubble.
It's a total lie. It's a total speculative bubble. He's lying. Just like when we heard the other day, the guy come out and say, we have a market that's just spectacular. What was the word he used? Sizzling. Here, play it. Sizzling.
What do you make of all these numbers? You do this every day.
It's you started off talking about a temperature check. I say sizzling. That's the temperature, sizzling.
I don't want to hear it anymore. That's a bold-faced lie, okay? And he knows it. The market is not being driven by earnings, okay? That claim is totally wrong, and that's what you're hearing. Matter of fact, we just played a cut. Earnings growth is too narrow. 12 out of 700 stocks? Give me a break. And the earnings are coming from all tech, all AI-linked mega caps. the communication service stocks, chips. So, and these market caps are far larger than earnings gains. So this guy doesn't know what he's talking about. I mean, that's the definition of multiple expansion, not earnings-driven growth. The guy's either doesn't know what he's talking about or he's a liar. The S&P, the PE has expanded. That's speculation. That's not earnings. He's got to go back to Phil's gang school. Now, the market, and if the market were earnings-driven, the PE ratio would be flat or falling. Instead, the PE has been expanding, meaning prices are rising faster than earnings. For heaven's sakes, that is not fundamentals. That's sentiment. That's liquidity. That's the Magnificent Seven. They're doing all the heavy lifting, And the rest of the market, the earnings are flat. Some are negative. Now, if growth was truly earnings driven, it would be a broad market, not just a handful of stocks. So we have a real economy fundamentals that are weakening. They're telling us how strong the economy is. Are you kidding me? So they come out with the numbers telling us, oh, look at this. Consumer is strong. No, he's not strong. Yeah, but look how much buying they're doing. Yeah, but they're spending more money, but the amount of stuff they're buying, units per sale, are going down. That's the one thing I never liked about the government. They never tell us how many units. If you own a business, right, you always look at two things, margins, right? You also want to know units. So if I had 1 month there was 100,000 sales and I sold 50 units, and the next month I had another 100,000, but I only sold 40 units, something's wrong. What's wrong is my margins. I can't keep my margins. So again, so they're trying to pawn off on us the economy and the fundamentals are really doing. They're not. We have a terrible inventory situation. Durable goods. Nobody's buying durable goods. When you want to know how bad your economy is, just look at the durable goods orders. They're negative. Durable goods are anything that they build, like a TV or anything that lasts 4, 5, 6 years. Real wages are down. And they always tell us, oh, we're doing terrific. Our wages are going up compared to our costs. That's a bull-faced lie. Consumers are really stressed. And a market that's driven by real earnings and strength would not be relying on fundamental weakness. I mean, it's unbelievable. So again, the market is being driven by liquidity, not earnings. Treasury issuance. That's what they're doing. Okay, here, buy more treasuries. Try to keep those yields down, right? And everything's all hype. And look at the stock buybacks. That's still going on. So again, we're hearing just so much garbage. The market's not being driven by earnings. That's all we hear is they're being driven by strong earnings. No, it's not. It's not. It's being driven by liquidity. And that's not fundamentals. That's pure speculation. And when we hear how, the market's sizzling, the economy's sizzling. No. April wages were up 3.6% year over year. But gas is up 28%. Food, rent, everything we need is up about 4%. Between 3.9 and 4%. Our wages are at 3.6%. So what are they talking about? Now, they said retail sales were up 5% year over year. They expected 3%. They go, isn't that great? Wow, people are really spending. No, they're not spending. The consumer's not doing well. Your gas, leaned up 28%, your rent, your food, insurance, utilities, their paycheck is getting eaten into. So here we go again. That's why they don't report units. And I've always said that. They got to start reporting how many units are sold. Because Wall Street lies through their teeth and said, look at this, we're up 5%, the CPI's up 5% or whatever, right? And it's not. People are paying more for food, gas, all these items, and it looks like they're spending more money, but they're not spending. Sales aren't up. The cost of sales to the consumer is up. So if you go and you're paying for 5 apples, right? It's $5, and the next week you go buy 5 apples and you're paying $8. Oh, look at that. Isn't the consumer strong? No, I want to know how many units that was. So you see what's going on here? So the PPI came on year over year. It's wholesale, 6%. And in the CPI, the retail, that's driven by gasoline, energy, insurance. That's not booming. And the proof, as I said a moment ago, that we have a terrible economy is durable goods sales. They're minus, they're negative. That's the killer. That's the killer. So again, it's units sold are down across the country, across the economy. Every business owner sees it. He's not selling as many bicycles. But when he looks at the end of the month, he'll say, oh, I did $4,000 this month. But he looks and he says, oh, yeah, but I sold 3 less bikes. But I had to move my price up because my wholesale price cost me more. So I had to move up my retail price. So I look like I'm doing good, but when I count the units, I'm selling less items. And that's how people go bankrupt. And if you own a small business, always remember, your lifeline is margin, margin, margin. Don't think you can cut your margins to do more sales. You'll make it up with volume. There's bankruptcies all over, people who left behind who thought that. This I can do it in volume. No. You don't want to do that, not at all. And then they're lying to us about the labor market. That's one big lie. That's how great the labor market's strong. No, it's not. It's not strong. It's stretched. It's stretched. Full-time jobs are down. Part-time jobs are up. We went over this last week when they came in, and that's when pain goes on. Sizzling. What? We have more part-time jobs than anything else. The good full-time jobs are down by 100,000. The lousy part-time jobs are up. They added up over 100,000. Are you nuts? A healthy labor market creates full-time jobs. We don't have that. We have a stressed labor market that creates part-time jobs. So right now, full-time jobs are tanking, part-time jobs are going up, multiple job holders at a record high. Now tell me how strong the economy is when you have a record number of people having to have 2-3 jobs. Is that a sizzling economy? Is that sizzling? I don't think so. And we're seeing all the job growth they brag about. They're all the gains are in the wrong places. Government jobs, healthcare, hospitality, temp workers. I wish it was in manufacturing, transportation, warehousing, tech. It's not. It's all low-paying jobs, like hospitality. I mean, thank God we got the jobs. I'm not putting the jobs down, but would they please stop lying? So that's why when everyone asks me, well, what do you think the market's going to do? Watch your 10-year treasury, okay, and watch your investment grade bond. Subtract the investment grade bond number from your 10-year, or just do it this way here. We're at 4.45. If that heads to 3.75, we're in danger. If we're 4.45 and it goes up to 450, it keeps going up, we're in danger. So that's all you got to remember. Remember, put your stops in. Learn how to sell short as well as long, and you do just fine here at Phil's Gang. Free for 10 days. Check us out. See you guys.